So you're all familiar with the topic, mergers and acquisitions. And most of you, not everybody, but most of you have had some good experience dealing with M&As over the years, selling a company, buying a company, selling a division, divesting portion of a company, all that stuff. And whether you've done it once, twice, never, or many times, it's always a good exercise to be able to step back and kind of look at what the process is and to think about it rationally and to help get yourself a little bit more prepared for that next transaction that you do, to be able to take both an experience-based but a rationally based approach to preparing for the deal and executing the deal. So speaking to us today, we have Rick Wilson, who was also assisted by Thomas. Oh, Thomas, I'm drawing a temporary blank on your last name. Thomas Powell. Rick Wilson has over 30 years of experience in investment banking. He started as a CPA with E&Y and moved out of public accounting into investment banking. Has been with a few firms and has now been for a while managing director at Crutchfield Capital, investment banking firm based out of Houston, Texas, and has had a lot of experience, over 100 deals, both the buy side and sell side, helping ensure success of the transactions. So he's going to bring that experience to us. We're going to be learning a lot by listening to what he has to say today. Thomas is with the same firm, a senior vice president with Crutchfield Capital, and has very similar, although fewer years of experience than Rick does. And Thomas has worked a lot with Rick and continues to work with Rick on a number of different deals. And I should mention that both guys have their undergraduate degrees in finance and accounting, with Rick also having his master's degree from LSU in finance and accounting. So with that introduction, let me turn it over to you guys. Take it away.
Thank you, Dan. Appreciate the time that we have to spend with your group this morning. I've had the opportunity to speak to the Thing Group here in Texas a couple of times, and I enjoyed it mainly because I got to talk about what I do every day, which is primarily working with the CFOs of middle market companies, going through transactions. So this morning, what we'd like to cover, initially tell you a little bit about our practice, the marketplace as we see it today, and then spend most of our time talking about how CFOs can impact value in a transaction, how they can benefit the shareholders of the company they represent. The goal is that we think that many CFOs should be thinking like we think, like the investment banker is thinking about a transaction, and how can you serve the owner best to maximize value. What we plan to do is, as we go through our presentation, we'll give some examples, both on deals that we've closed, as well as some deals that we're currently involved with. I'm happy to take questions as we go. And given the background that some of you all have in M&A, any observations that you'd like to make along the way, any examples that you're able to share, we'd appreciate hearing. Okay, can everybody see my screen?
Yes.
So our firm, small firm, we have 10 employees. We've been around over 30 years, Texas-based, focused in the lower end of the middle market, typically companies with EBITDA between 3 million and 50 million. Our clients are generally more mature businesses We work across most industries, although surprisingly based in Houston, we don't do much in the way of oil and gas. Our clients are generally the original founders of the companies, and they've typically never been through a transaction. About half of them have CFOs, but many of the CFOs have not been through M&A. And so we're going through a process, kind of holding their hand the entire time, teaching them, instructing them about the data requirements and the process and what's needed to come out of the end with a successful transaction. Given the nature of our client base, we spend a lot of time with the finance teams. I like to think of ourselves as basically serving as the transaction CFO, if you will. We've got 4 partners in the firm, so we do tend to get very deep inside each of our engagements at a senior level. And we found that's been very helpful in terms of successfully concluding the transactions. I spend a lot of my time working with the CFOs and the controllers of our clients, helping to model their financial presentations. And many times they simply don't have the data gathered that's essential to present the best story. They haven't done projections. So we're starting from scratch in many cases. To give you an example of some of the types of transactions that we work on, the one top left, Covetrus was a buyer of a SaaS-based business, a veterinary practice scheduling software business that we sold a year ago. Bottom left, we sold Maintenance Supply Headquarters, which was a multifamily distribution business. We sold them to Lowe's. That was 5 years ago. We've had numerous value-added distribution clients, manufacturing, logistics clients, and again, all in the lower end of the middle market, companies generally from 10 years of age to 50 plus years. In terms of the market activity, as most of you are aware, 2021 was a fabulous year. Over 17,000 transactions in North America, 2.7 trillion in value. We're seeing a slight slowdown going into this year. We think last year was driven by many factors, interest rates, the economic outlook, stock prices, and also driven by tax concerns. So we saw a lot of sellers trying to get their transactions closed by the end of last year. Our expectation is that we'll see somewhat slower activity this year, although in our firm, we've not yet seen that. One of the unique things about being in the market today, we heard with the introductions, a lot of people that are working with private equity groups, either on the buy side or the sell side. Private equity sponsors tend to be the super majority of the folks that we speak with when we go to market. The dry powder is, I've seen estimates anywhere from 800 to 950 billion. And what we find with the private equity universe is those groups are always prepared for a transaction, whereas the strategics, in many cases, if the timing isn't right, they're just not going to be in the game. In terms of valuation, generally the deals that we work on, valuation multiples are 6 times EBITDA to 12 or 13 times. Most are in the single digits. Those that will command the higher valuations will be healthcare, information technology, where the themes are the prospects for growth, as well as the resiliency in their business models. The more cyclical businesses and industries, for example, in energy, are going to see a wider range of valuations. Common issues we're seeing today with our client base is supply challenges, supply chains being back up, labor shortages. We have one of our large clients that has a very significant backlog that is the largest they've had in their history. They are unable to give us a firm estimate on when that backlog will be produced. It's a good story to tell the marketplace, but it's a very difficult projection to make with credibility, given that there are so many supply shortages for this particular company. Inflation, of course, is on everybody's mind. We're seeing elevated cost in labor and energy and materials costs. It makes it very difficult in performing these projections. In many cases, we're seeing companies that are unable to have comfort with their outlook, putting the brakes on a potential transaction and waiting until things become more clear. What we'd like to focus on this morning is what areas of an M&A transaction can you control? What we just covered are the areas that we really don't have control over. But we do see our CFOs and the clients that we work with having very significant potential influence. Some of the ideas that we'd like to share are fairly basic. Some are more strategic. Our sense is that it takes probably in many cases up to 3 years to make the changes that are essential in order to have the best potential outcome in a transaction. We like to begin our engagements with developing the financial story. And we see in many cases the CFOs being able to drive the change in the organization needed to make these improvements, being able to articulate the value of the opportunity. It's not so much just looking at the historical trends of EBITDA, gross margins, but we like to think of it in terms of what are the key investment considerations. When we prepare the offering memorandum for the companies, we spend a great deal of time getting to know the business, what the outlook is, what the opportunities are, and why should an investor pay top dollar for this potential investment. One thing we think is very important for business owners, and this is driven by the CFOs, is to assess the company's marketability and transaction risk. We enjoy seeing a long history of steady growth in a company, looking back at least 10 years, what influences were there on the revenues and profits, identify what the recurring revenue streams are, versus the more transactional revenues, and what is driving the revenue stream. Is it a discretionary purchase? Are they essential? Having been through the pandemic, we were able to see some really good examples of, the essential businesses versus those that were much more discretionary. Measuring the profitability through the business cycle and the pandemic was a challenge. Many times, folks were hanging on to their employee base to maximize their PPP forgiveness. We spent a lot of time with QB firms analyzing the potential for presenting a company's historical financial information without the employee base that was held on to throughout the pandemic. The customer base is obviously a critical component to valuation. Not only the customer concentration, but what the value proposition is to the individual customers. For example, if you're selling to OEMs, if you're doing new build work versus are you selling replacement components, are you adding labor to product that's being distributed. We want to find where the highest value is. How do you compare against your competitors? Are you taking market share from your competitors with your existing customer base? Are you giving it up? In the case of Maintenance Supply Headquarters, the distribution business, it was a wonderful 10-year history where they were taking significant market share from their competition. And that was an excellent part of the value proposition that we're able to make to the market. Another aspect of assessing the business is when you go to market, what are the buyer's alternatives? Are there others like your company that they could acquire that do the same thing? We spend a lot of time comparing each of the competitors to our clients and knowing what strengths and weaknesses each of those has. In the case of Maintenance Supply Headquarters, it was a wonderful story because there was really nobody else like them in their size. They were based in Houston. They had 15 to 20 branches across the US. And they were such a unique opportunity that we were able to get Lowe's to pay a valuation much greater than anybody had anticipated. We like to look at the scalability of the businesses as well. Are the roles or the critical roles in the organization all filled? Is the company able to expand its branch network with its existing infrastructure? Will the business be viewed as a platform in the private equity world where you can rapidly expand via acquisition or organic growth? Or are you going to be focused more as an add-on opportunity for a portfolio company? And then finally,
Rick, a question for you. Are you seeing any effects from the Ukraine war on things like relative market share of companies, or companies taking share away from others or losing it to others, or perhaps as a result of supply chain issues? Anything that the Ukraine war is having an effect on in this area?
in fact, that's a good question, Dan. One of our clients, I was going to talk about a little bit further into the presentation, is a steel distribution and processing business. And what they've seen is a very significant increase in steel prices, which serves them well because their revenues are obviously driven by steel prices as well as volumes. And they were anticipating a decline in steel prices this year as we were entering the market, and they've benefited very significantly as a result of the steel prices, which are up, I want to say, Thomas, if I'm not mistaken, about 30% over last year. Very significant increase. We're expecting that to fall off, but the war was actually quite beneficial to their financial performance.
Now, does that get discounted by any prospective buyer who says, well, this is temporary? Or how does that play through typically?
Well, in this case, we're working with a very credible management team who acknowledges that, we're at first half of the year, we were at all-time highs in terms of steel prices in their markets. And they helped build out very detailed, very granular projections on a product by product basis over the next few years. And they are making very credible assumptions about declining prices. And so we would anticipate that most folks would look at their historical performance on a pro forma basis based on where we think steel prices are going to level out. So, so the last bullet here was on the internal dynamics. The one of the keys here is the internal personnel and who are the key players needed to have a successful transaction. We've had some unfortunate experience where key participants were either not made aware of a transaction in advance, or they weren't adequately compensated for the transaction. And our strong recommendation to all of our clients is if they're a key player, they need to know up front, they need to be financially motivated. One deal we closed last year was with Camp Construction, which does restoration and renovation in the multifamily markets. They had one of the best CFOs that we've worked with, who was very highly compensated for the transaction. And it was an experience like none other that we've had, going through QB and all the challenges that we went through with the specific buyer that we worked with. But you had an individual there who was absolutely key to the success of the transaction. And so I think it's a mistake not to have those key players motivated and aware prior to engaging in a transaction. One area that is not always easy to do, this is more of a wish on our part, but that is to have a strategic growth plan. Many of our clients have not really thought through what it would be like if they had unlimited sources of capital. But we always start that conversation with, clean slate, you've got all the money you need, how do you grow? And as many of you are aware, in the private equity world, growth is key. And whether it's by acquisition or by organic growth, if your customers are pulling you or requesting that you move to new geographies, that really does support the story quite well. The steel client I mentioned earlier, when looking at their projections with declining steel prices and somewhat moderate tonnage volume, we came to the conclusion that, we need to make this a growth story that's credible. And because they have such an excellent platform, we help them to create the growth story around acquisitions as well as customer expansion. And we think that we're in the market right now. We think the market's going to receive it very well. Even though it's a very mature industry, we like to think of them as disruptive to the industry norms and having some excellent growth opportunities. In terms of the internal makeup of the organization, the human capital issues, one of the experiences we had is with EOS, Entrepreneurial Operating System. And I don't know if anybody has worked with that or if they've seen it in place, but we've had a few experiences with companies that had it. Sorry about that. We've had a few experiences with companies that had it in place, and Camp Construction was one in particular. Camp went from 5 years ago, very low profitability. They became involved with EOS. They had an implementer that came in, and it's a relatively simple concept. It's essentially to set the vision of the organization, assign the key roles to people, and it may not be the owner or the CEO who stays in that position doing the same thing day to day. And then you have a set of metrics that you set to help you drive the business, and you follow it with weekly meetings. What we found was, number one, the company had been, it was demonstrating much improved financial performance, and the reporting systems that they had in place, the KPIs they tracked on a weekly basis, were a key part of our presentation to the private equity world. And it was very well received. People saw it as a very credible method for tracking the organization, monitoring individual performance, and really getting your arms around how to make this company a lot more valuable. Another area that we think, with respect to the financial part of the equation of transactions, a lot of folks don't think about the working capital management side of maximizing value. We've seen many buyers that working on the buy side in our firm, they love to see a bloated net working capital. Oftentimes they can make the acquisition, with the target working capital being what it's averaged over the prior 12 months, and then they can squeeze it down and pull that excess off the balance sheet to help finance the transaction. Where we've seen great success is where there are the incentives for employees in billing and collection, inventory management, safety. In the case of maintenance supply headquarters, they literally bonused every single person. They had measurements to see how each person performed in their jobs. And so everybody was highly motivated to meet the standards. Another area that we recently explored was the early pay discounts on your trade payables. It does help on the EBITDA calculation, but it will increase the net working capital. And one of the nuances that we studied recently was, to the extent that when you think about the EBITDA and the value driver there, that's a pre-tax calculation. That net working capital, that's a net of tax calculation. And so if you're in a low multiple valuation, it may not make sense to take the early pay discounts, but rather to minimize your net working capital prior to that transaction. And typically, you want to do that at least a year before the transaction, since the trailing 12-month period is generally used in setting the target. We see many companies, many of our clients do not have audits, many don't have reviews. It can be very helpful to have either the audit or the review. In many cases, our clients have multiple business units that they don't consolidate. Being able to perfect the monthly close becomes important, especially as you approach 1 year out from a transaction. We like to track at least 3 years of monthly financial performance, doing a quarterly summary of what those trends look like. And then as we become closer to the transaction date, calculating a rolling trailing 12-month performance. To the extent there are period distortions kind of baked into the financials, it becomes very difficult to understand the true financial performance. Things like audit adjustments being taken in the final month of the fiscal year will distort that particular period. So we encourage our clients to think very mindfully about monthly closings that are not being distorted by events that occurred in prior periods. Consider using percentage completion accounting where appropriate and material. Many of our clients do not use it because of the difficulty encountered on trying to track that on a monthly basis. We end up going back and having to restate the internal statements based on how many of those projects turned out. So it does take a fair amount of time if that's not being done on a regular basis. Another area that we find is troublesome is where there's a significant amount of inventory, especially in distribution businesses. If they haven't performed adequate cycle counts, they haven't analyzed the reserves for slow-moving inventory, that can be problematic as well going into a transaction. We've seen several of our clients with multiple reporting units having all different charts of accounts. Makes it very difficult to track and consolidate the statement. So we encourage, a common chart of accounts across all reporting units. And then finally, when considering, transaction in the next few years, I would recommend carefully evaluating both tax strategies and legal strategies. For example, if you are a C corporation and you're opening up a new line of business or opening up a new location, don't necessarily need to retain the C Corp status. If you can establish a pass-through entity for additional lines of business or additional locations, that could be beneficial. From a legal structure perspective, to the extent that you can mitigate risk, for example, having real estate owned in separate legal entities. If you have multiple contracts, in the case of some of our clients that have literally hundreds of contracts across the US, to avoid having to obtain consents for all of those upon a sale, if those are in an entity that you could transfer the stock, then you might be able to avoid that potential risk. And then, of course, any key business agreements, you would want to make sure that you can have as much negotiating flexibility so that those transactions can be assumed. In our Steel client, we were fortunate to be involved with a new customer agreement that they're putting in place. It was a 7-year contract. So we were able to give some input in terms of ensuring that that contract would be assignable without any potential consents required. So beyond the basics, the financial reporting, one of the things that we often have the most difficulty in obtaining from our clients is essential data that's needed for us to prepare our offering memorandums. So not only is it the typical non-recurring or out-of-period adjustments to EBITDA or the affiliate and related party transactions, in some cases there are expense items that are more appropriately capitalized, either if it's allowable under GAAP, or if we can make the argument that it would be not considered a current period expense. One of our SaaS clients spends a lot of their effort in developing new products, and we were able to obtain the rates and the hours of the personnel used to do the development work. So it enabled us to create a better story about the historical performance. We would also recommend considering normalizing all the related party expenses to the extent that you can. And of course, preparing annual budgets and doing monthly assessments. And if you're in an EOS type environment, it's more of a weekly assessment. And then of course, using the KPIs throughout the business. What we find is, and Thomas will address this in a minute, is that not all KPIs are either calculated properly or applied to the industry like they should. We find that having a long period of data that is used to build credible projections can be very beneficial in transactions. Thomas, I'm going to turn it over to you now.
All right, sounds good. Hope everyone can hear me all right. But here I wanted to talk about some valuable information to capture that's in addition to the essential data like sales by customer, purchases by vendor, so on. So first up is customer geography or sales by state or metro. And depending on the business, depending on how you group your customers, this can be an easy task, or sometimes it could be more difficult, but it's good information to have because it helps us prove growth potential by showing the market where you guys are currently and where you could go next when you start talking about geographic expansion or expanding your customer base. So that's a good one there. Next, revenue by end market or application. Example here is we sold a company that distributed diesel engine parts and components, and they were serving a wide range of end markets, all the way from like the transportation, utility sectors to oil and gas, forestry, all that kind of stuff. Anywhere really where a diesel engine is used. And what we noticed and what the market's feedback was, some of these end markets are way more valuable than others. So for example, the transportation and utility sectors, those are more consistent. The spend is more tied to maintenance versus their oil and gas business, which, when the market was good, it was extremely profitable, but there was a lot of volatility in that side of their business. So it was seen as more of a risk. These next two, revenue by sales channel and revenue by demographics, these are kind of similar in concept to revenue by end market, but are really good to capture, especially depending on what kind of business you're in. If you're serving multiple different kinds of customers, for example, like resellers, end users, manufacturers, they also allow us to categorize your customer base by, for example, maintenance related demand versus manufacturing related demand. The maintenance is, in almost every case I've seen, is more valuable. Next up is wallet share, and this is essentially how much of your customers spend are you capturing versus how much are they spending elsewhere, say with competitors or something like that. This is one that can be difficult to know for sure for a lot of businesses, but it can often be estimated using industry data or feedback from your sales representatives. And it's a great metric for us because it essentially tells us how much growth is still available with your existing customers if you continue penetrating their spend. And that's almost always an easier business to capture than having to go out and find new customers and sell them on why they should do business with you. Next up is market share, and this is another one that can be often difficult to get, but sometimes it can be estimated. For example, maintenance supply headquarters, Rick spoke about them. They were a distributor of maintenance, repair, and operations products for apartment communities. And what we did with them is they had really good data. So we were able to look at how many properties were in their markets versus how many of those properties they were serving. And then we multiplied that by their estimated wallet share. And that allowed us to demonstrate kind of an approximate market share. And more importantly, allowed us to show the market how much white space was still available in the markets they already had. And then these last two here, these are, I kind of see these, grouped together. But essentially these metrics help us bridge gross profit from one period to the next. For example, how much profit growth is coming from changes in volume, how much is coming from price increases, and how much is coming from cost reductions. These are also relevant metrics to track if you have a business that has commodity price exposure. Rick's talked a good bit about the steel company that we're working with. They actually use this kind of data as the foundation for building their projections on a granular basis. So if there's no questions there, we can go to the next. So here I want to talk about best practices for handling your data, and what you provide to us, what we provide to the market. So the first one here, and Rick's already mentioned this, but I want to stress the point again, the side-by-side monthly financial statements with consistent chart of accounts, meaning the accounts don't jump around, it's easy to update. This is one of the most common problems that we see on a regular basis, and is typically solved by just checking the right boxes in your accounting system. Most accounting systems, there's a way to do it. And it's just a matter of figuring out, how to check those boxes. But that saves a whole lot of time down the road in the process. Next, I want to talk about revenue by segment with COGS that match that revenue. So seeing revenue by segment, that's pretty common. A lot of our clients do that, but it's very rare to see the cost of goods in a way that lines up with those revenue breakdowns, which can make it pretty difficult to analyze segment profitability. So to the extent it's possible to kind of match those up when you're creating your segment categories, that can help a lot. Next, want to talk about consistency and naming as it relates to your customers and also your vendors. But customers, this is one area that this causes me a lot of pain. But I can't tell you how many times we've been looking at customer data and the names are misspelled between years, or there's multiple accounts for the same customer with slight variations in spelling. For example, think like ABC Corp versus ABC Inc. Same company, but it's just entered in differently, usually by two different people. So having a system that kind of keeps that clean is very helpful. And one thing that we always recommend here, and ties into the next topic, is using master accounts or unique identifiers to group together your related names. And we'll get to an example on the next slide there. So I'm going to skip that for now, and then we can come back to it. Jumping down here, next one is having fully burdened gross profit by product and customer. This is similar to one of the earlier ones I talked about, matching your cost of goods to your revenue segments. But this is as it relates to your sales by product data, sales by customer data, but it's the same concept essentially. But to be able to have your cost categories match your sales categories really helps when we're trying to look at profitability, whether it's by business segment or by customer or by product category. And that helps us as we're putting together a story to tell the market about the business.
Hey, Thomas, a question there. Do you often find, or do you sometimes find, that your clients, for want of a better term, are woefully under-systematized in terms of being able to do some of the critical breakouts?
Some are. And a lot of times it's just never thought about capturing the data, or it was a little too complicated to set up in the beginning, and so it was just never done. Most systems, unless we're talking about something that's just doesn't have the capabilities for the type of business, most systems can capture a lot of this data. It's a lot of times just a factor of whether you use those features or not. So a lot of it goes to pre-planning.
So will that sometimes actually slow down a transaction where you have to tell them, hey guys, there's some critical info we need and you need, and you know what, you're going to have to get that in place before we can move ahead.
Yeah, absolutely. And we've seen it so many times where they're not tracking that piece of information that essentially proves the story we're trying to tell around the growth, future growth or historical growth, and might be able to capture that data, but they're currently not. And so a lot of times we have to figure out ways around it, kind of how to hack it together, or show kind of examples that prove the point. And that adds time to the deal prep process, and it delays us, in our ability to get to the market.
Right.
All right, and then before we go to the next slide, this last one here, I want to talk about revenue retention, and this is something that can be relevant for anyone in the SaaS world, anyone that has a subscription model, or if you have a component of your business that has a subscription model, or even if you just have a fair amount of recurring revenue. I'm thinking insurance type businesses, utilities, that kind of stuff comes to mind, where the revenue is pretty recurring, even though it's not a traditional SaaS model. So there's two main components that we look at when we do a retention analysis. The first is gross retention, and this factors in your customer churn and your downsell. And when I say downsell, I'm talking like feature cancellations or a decline in the number of users. And this information tells us how well the business is doing at maintaining its existing customer base. This is before we start talking about new customers or increases that you've had with customers. So this is really just kind of worst case scenario, and it shows us how fast the company is bleeding out, essentially. And then the second piece is what we call net retention, and this takes your gross retention and adds upsell to it. And so when I say upsell, I'm talking about like product add-ons, feature add-ons, or rate increases. And you add those two together to calculate your net retention, which tells us how the business is doing in terms of, can it generate growth solely from its existing customer base without needing to add any new customers. That can be a pretty good growth story if that's the situation that a software company or someone else with a recurring revenue stream has, where your existing customers are essentially supporting the baseline growth, and then everything on top of that is just it's just extra. It's also important to note here that this is the way that investors often look at your recurring revenue. So if it's not something you're doing now, it's a good idea to get familiar with these concepts, so there aren't any surprises when you start talking to investors. All right, if there's no questions there, we'll go to the next one. So this relates to the topic briefly spoke about regarding master accounts or unique identifiers. And I put this example together. It's a little bit of an oversimplification, but I think it gets the point across. But if you look at the 12 accounts over here on the left, and just keep in mind that in the actual data set, there's more like thousands of these. Obviously that won't fit on the page. So it just took a handful of them to kind of show you what we were looking at. And this company here, you can see these are restaurants. This company is a distributor of produce in the Gulf Coast area. And they primarily distribute to restaurant chains, family-owned restaurants, all that kind of stuff. And when you look at these, you can see there's a lot with similar names. And in order to show kind of your maximum concentration risk, I like to group everything together. That kind of shows worst case scenario if a restaurant group leaves. Now, sometimes the decision making is done at a unit level as opposed to a corporate level. But in order to show kind of your maximum risk, we like to group everything together. So this is pretty easy to do for the top block in blue and the bottom one in green. So the Papa's restaurants up here all have similar names. So that's pretty easy for, someone like me to go in and categorize. Same with the Good Company restaurants. Where it gets complicated though is with this group in the middle. These are all part of the OSI restaurant chain. Or Outback Steakhouse and other brands owned by that company. And this one can be difficult because there's no real clear way of knowing what restaurants were part of which restaurant group at what point in time. And that's because a lot of times these brands change hands pretty frequently, or there are always new brands being brought into the chain. And here to make things more complicated, you see this one in the block in the middle here. The first one there is Carrabba's, which the Carrabba's chain is part of the OSI family. But then you also have Carrabba's, the original restaurants, which are owned by the Carrabba family. And at one point in time, those actually were all related, but they're not anymore. And so you can see that can be kind of complicated. And for someone like Rick and I, understanding the nuances, we're never going to understand it perfectly as well as our client would. And what we actually ended up having to do here, because there was there's so many unclear accounts in their customer list, is we actually had to have the client go in and group these by hand for us, which was pretty time consuming. And I'm sure it was not the most enjoyable task for their CFO. So if your system allows you to add in master accounts and your data looks like this, I strongly suggest setting it up so you don't have to do it down the road, especially if you're in the middle of a sale process and there's a ton of other stuff on your plate. So I hope that's been helpful, and happy to take any questions, or I can turn it back to Rick for the next slides.
Okay, and I'll go through these last few slides pretty quickly. I know we're coming up on the noon hour. So the 1 year before pursuing a transaction, recommendations are, first is to try to minimize adjustments to the financial statements to the extent that you can. Evaluate these out of period anomalies, whether those be the audit adjustments being posted in the proper periods, tracking the non-recurring unusual expenses, and looking at any potential pro forma adjustments you can make, like insurance savings, discontinued operations, could be supply chain disruptions.
Hello.
And then also consider
Do me a favor. I'm on a call in New York. Can you call back and leave a message? She's not here.
Consider the
Yeah, please.
Jenny, can you put your phone on mute?
consider
Okay, I think we're okay.
and a few nuances include if you're an income tax paying entity, deferred tax assets you don't get credit for typically, whereas a deferred tax liability is treated as debt. So you need to look at those potential assets and liabilities and try to avoid being discounted by any of those elements. We also recommend preparing the annual MD&A, we call it, which is what we like to do with the CFOs as we enter the engagement. We typically spend a lot of our time helping them generate the projections. And as Thomas was talking about the historical data, to the extent that we're able to trace back for a few years on kind of the foundation for the projections, it'll make these projections much more credible. For many of our clients, they maintain a backlog and a sales pipeline, and we use that as, again, the foundation where we do probability weighting on the pipeline. And it does take a lot of time, talking to salespeople and trying to gather the information. But to the extent that that is happening in advance, it makes that process much easier as we're approaching the market. And then finally, recommend beginning to build the internal data room, where essentially you're gathering the kind of the basic information that will be requested, but you have it organized in a way that's easy to access. It's probably appropriate at least a year out to begin conversing with potential investment banking representatives and consider the size and personality of the firms if they're a good fit. And I'd recommend that CFOs network with potential investment bankers and understand how they look at businesses like theirs. Ask about valuation. What are the key drivers? What are the KPIs? How does your company compare to others that they've worked with? What issues do they see? And then, assess what you're hearing from them. You ideally are going to be able to hear a lot of quality information about, how the business would be viewed in the market today versus, if things were different within the business. And that can be very helpful in terms of positioning the company before you enter the market. Many of our clients, I'd say probably half, will do a sell-side quality of earnings. And we find that that can be very helpful to accelerate a process. It's not always needed. What we found is some of the better run organizations, for example, Camp Construction, they were able to provide all of the diligence information in 2 weeks, which typically, will take a couple of months. But they were so well prepared that it made quite an impression on the buyer. And Camp did not have a sell-side QV, it was all buy-side QV. But going into it, they were well prepared to embark on that diligence. And then finally, look at creative ways to present the financial performance on a pro forma basis, eliminating discontinued operations or discontinued product lines, addressing any permanent expense reductions, any excess costs that you can back out of a run rate. The way I like to think about it is, the GAAP is for accountants, but we're really dealing with the investors and want to think about the economics of a business and what type of resources it can produce with the right stewardship. One of the examples I'd like to give is, and this was on Camp Construction, what I call the but-for analysis, and it became very useful in our process. Camp had a fantastic third quarter of 2017 when Hurricane Harvey hit Houston. What happened was, you can see in gray, their business surged. In 1 month, they did 30 million of revenues, and primarily that was from Hurricane Harvey. But the result was their non-Harvey work, their more recurring revenue began to drop off. And you can see in the fourth quarter, it wasn't really impacted, but then as the Hurricane Harvey restoration work ramped up, we saw their more traditional recurring revenues fall off. And the reason for that, as we explained to the market, was the customers were focused on rebuilding and not doing any renovation to their multifamily communities. The challenge we had, though, is the lenders and the investors would look at the history and say, in 2018, so much of your revenues and earnings was Hurricane Harvey related, which was an event, and the rest of your business is down. So it became quite difficult for people to see that. Fast forward to 2019, we see the Hurricane Harvey business moderating and declining dramatically, and then we saw the return of that regular recurring revenue. We took that story into 2020 when we had 2021 when we had the freeze, because what happened with the Texas freeze was a very similar result, where all of a sudden we saw a huge jump in revenues from Texas freeze restoration work, with a big drop in other recurring revenues. So having this story that we were able to tell helped convince the market that those one-off events are very profitable. They temporarily will bring down the recurring revenue stream, but history was helping show that that recurring revenue does return. Another brief example I cover is, and this was on Maintenance Supply Headquarters. This was a fabulous company that had a kind of storybook type financial performance, excellent sales growth and gross profits and EBITDA. And one of the issues was that the profitability was coming from their established, more mature branches. So you can see, almost 90% of their revenues were from these established branches, where they had penetrated the market so deeply that one of the issues of concern was how much more could they grow in those markets. Well, we were able to convince the market that all of the newer emerging branches would have the same growth rates that those established branches had. So you had, in the teens to the 20s and 30s, 5-year growth rates in those established branches. So we were able to convince the market that these new branches under the same stewardship would have very similar growth as the more established branches. So that helped us quite a bit in establishing the value of the company and selling the business at a premium. So at the end of the day, the goal is that we're going to have multiple bids, and this is an example of a deal we closed 3 years ago, and we had 42 offers. And you can see the range of offers. And what's unique about this or interesting is only 2 strategics bid on the company. There were 40 private equity groups bidding, and the final top 3 were, within, a whisker of each other in terms of the bids. It was a fabulous outcome. It was a great company, and that company, 3 years after that sale, has more than tripled in value. And the reason is it was a family-run business that had been run conservatively. It had such an excellent profile in the marketplace that the buyer saw this as a great footprint for growth, to make acquisitions, and with more risk taking and more capital, they were able to significantly increase the value of the company in a very short period of time. These are the outcomes we love to see, and obviously the client was very happy with the outcome as well.
Hey, Rick, a question. I'm just curious. Were the 2 you mentioned, there were 2 strategics? Are those 2 light blue bars?
Exactly. Yes.
With significantly different numbers.
Oh yeah, exactly. It was almost comical, for a strategic to bid, a third of what the top bidders were offering. The strategic on the right was actually a very large competitor who was an ESOP. And while they had a pretty compelling offer, there were some issues with the structure of it. But we were happy to have at least that one strategic up there in the mix.
What a range.
Yeah, quite a range. Yeah, this is a slide that gets a lot of people's attention. Ideally, you're going to have many offers to consider. Fortunately, our client wanted us to go very broad into the market, and we were very pleased with the outcome. So Dan, this is all we had for today, but we're happy to take any other questions, and obviously love to hear any comments folks may have about some experiences they may have had that may have resonated with some of the topics we covered today.
Yeah, just a lot of stuff. And I guess one of the key messages seems to be, I mean, no big surprise, but the more you can think ahead as to how you're going to want to present your data long before you actually have to do that presenting, the better prepared you're going to be. You have to be thinking well in advance as to how you need to cut your data, probably what data you need to be collecting that you may not already be collecting.
Exactly.
Yeah.
Exactly. And time is never on your side in a transaction. You know, we've had some deals that, you know, 2 weeks before closing were pulled. We've had deals that closed, you know, a week or so before there was a crash in oil prices, which, you know, we were fortunate to get done. And so we never like to have any delays. So the more well-prepared people are to enter a transaction, we think the better the chances of a successful outcome.
Any questions or thoughts from folks here?
Yeah,
There's a
Dan,
wealth of, yeah,
Dennis. So great presentation today. I spent most of my career in Silicon Valley. I've done over 66 M&A deals. I work with a lot of the private equity groups. I don't know if you're familiar with Benchmark, Sequoia Capital, and Kleiner Perkins. We did a lot of work with those guys up north. And you're seeing a changing market taking place as we speak. We're going into a recession, as you know, and with the loan to equity structures changing right now, you're going to see a lot of companies that are going to have a problem with their loan to equity and covenants. And so you're going to see a lot of distressed companies coming up pretty quickly here that are going to have to be forced to do something. And part of it will be acquisition. So I think you're going to see a lot of roll-ups taking place between now and the 18 months. First of all, money is still cheap for the big guys that have the money to invest and take over companies. So I think you're going to see more of that coming. But the real key is there is a lack of sophistication with a lot of the firms that you mentioned that are lower, you know, mid-market and lower, don't have the sophistication in place to do a quick, easy transaction. So that's a level of difficulty we see going forward in the marketplace. So that's kind of where we are. So I think we're moving into uncharted waters between now and sometime next year. So the M&A activity right now on large scale is booming, but I think you're going to see that start backing off in the near term.
Yeah, thank you. We agree.
I have a question regarding the last slide. I would like to know why do you think there are only 2 strategic bids? Yeah.
Yeah, good question. You know, we did approach Thomas. I don't know if you recall how many strategics we went out to, but you know, it was a fairly unique business. That I'm remembering maybe at least 10 or 20 strategics that we went.
Yeah, I think there was like 100 on the list that we contacted.
Oh, wow. Okay. I think part of it is the nature of the industry may have been more less, call it less risk takers in the marketplace, kind of old line, steady state, you know, keep doing what they're doing and not be so interested in acquisitions. And I think given the focus of the company in, you know, diesel products, diesel engine products, it was a little bit too narrow for some. I think, Thomas, we went to some of the larger auto part suppliers as well.
Mm-hmm. Like Napa and them.
Yeah, so it was a transaction value kind of below that threshold. And so there weren't that many strategics of a size that would be willing to pay what it would take to be in the game. And I think the you know, the diversity there was just kind of weighed against having a larger pool of strategics at the table.
And do you think, given the current situation dynamic, there will be more potential strategic buyers in the short to longer run?
Are you saying with respect to this particular company?
No, for other transactions.
You know, literally on average, we get maybe 10% of the bids we receive are from strategics. We just see such a robust private equity environment. Now, many of the private equity sponsors may have a portfolio company, so they're a bit of a hybrid. But again, I think a lot of it is around the strategics, that if it's a publicly traded company or privately held, not backed with private equity that's seeking a 3 to 5 year turn, their motivation is going to be different from the private equity world.
Thank you.
And do the private equity guys, are they partly offering higher pricing simply because money is plentiful for them, or has been?
I think,
Or is it or rather, is it because they very quickly perceived, ooh, family-owned business, conservatively run, ooh, look at the potential here, and they were seeing things that the strategics just weren't seeing?
I think that's part of it. Yeah, in this particular situation, there was a lot of growth opportunity via acquisition. And as you know, private equity, would love to be in and out in a short period of time. And that's what's happening. They're making significant acquisitions. They're growing organically. So they brought in a new CEO, and that was by design up front, a new CFO as well. And so it was so well positioned. And strategists are going to have a different mindset about growth of a business. And so I think that's really the driver here. Now, the opposite happened with maintenance supply headquarters, where Lowe's could clearly bring some advantages to scale in terms of purchasing power. We did have a number of private equity groups pursue maintenance supply headquarters, and some were within, I want to say, 10% of the ultimate valuation, which was, we thought, quite a stretch. But Lowe's clearly, could dominate the valuation, and it was their deal to win. They were not going to let it go.
Rick, this is Tim Biddle. I just had a question. A few minutes ago, the consensus seemed to be that M&A activity is going to be slowing down, but do you think that's, how do you juxtapose that with the fact that there's 800 million in dry powder that private equity firms are sitting on, plus, and I don't know, maybe that number included SPACs, but the SPACs all have this window that's closing within the next 3 years, where they have to invest their funds, or they're going to lose a lot of money. Just curious as to your comments on that.
Yeah, it's a good question, because there is an adequate supply of capital to do transactions. I don't think you'll see lack of demand from the buyers. I think the issue is going to be more on the sell side with, what are the valuations? And if those sellers have not seen a recovery in their business yet, or if they are expecting, a higher valuation than what the market will bear, then the sellers won't be at the table. I think there's plenty of demand for deals, and it's all a matter about the valuations.
Okay, thanks. So a follow-up question to that, do you think it would be more beneficial for a seller in that case to sell via an auction process, or to try to go with a privately negotiated transaction?
We've done both. In some cases, MSH, maintenance supply, was an example of, very limited process where we went to maybe 10 or 12 different parties, given the size of the deal and the nature of the deal. More typically, we find success in doing a broader discrete auction like we did with M&D, especially if we know that there will be, a wide level of interest. And in many cases, you have a lot of financial sponsors that may have a new thesis that they are pursuing. And it's not always clear exactly who the best financial sponsor might be for any one particular transaction.
Got it. Thank you.